With world-class expertise and local insight, Dexus creates value not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello, and welcome to the COB. I'm Nadine Blaney, and it's a pleasure to be here with you on this Tuesday afternoon. Of course, a shortened trading week here in Australia, both ends of the week, and really interesting to see some of this market performance today. Ending in positive territory for the CIBO Australia Index. And, you know, we had a really shocking lead in from the United States. So only one company on the entire Dow Jones Index was in positive territory. I think 36 or 39 on the S&P 500. So I actually think it could have been worse than what we see here right now. Now, of course, the S&P ASX 200 is not quite as positive as we are seeing here reflected on the CIBO Australia Index, but I will bring you across the market close when, in fact, the last of the day's trades go through. Just looking around the region as well, you know, Asian markets holding their own despite that punch that Donald Trump is serving Jay Powell. So Trump saying that, you know, he's a loser, and that's a quote, and that he needs to cut rates now to avoid an economic slowdown, which arguably are being brought about by Trump's own policies. In fact, JP Morgan analysts say if there is no change to said policies, particularly around the tariffs, that there is a 90% chance of a recession in the United States. And of course, Trump doesn't want that to happen on his watch, so he will pull no punches when it comes to blaming Jerome Powell for not moving quick enough. Now, here today, I'm going to be asking my guest host about this one because, I mean, CBA, it's up by more than 4%. I don't know why, so I'll ask Martin Crabb, who is the CIO at Shaw & Partners, about that one in just a tick. Now, the other sector that we're watching with much interest today here locally is, of course, the gold miners. The gold miners continuing to soar, flight to safety into gold, its safe haven status, you know, really coming to the fore, particularly as we see the US dollar, you know, absolutely battered and bruised. So yeah, those gold miners, not only are a lot of them out with their quarterlies, but you know, the gold price just doing no harm there. All right, let's get across some of the sectors today. And here is the picture of CBA up by 4.3%. Now, Macquarie, as you probably heard, offloading its public markets business, its asset management arms in the United States and in Europe as well. It got a bit of an uptick off the back of that. It's pretty cashed up. I think it's $2.38 billion. That's a lot of money. Here's the gold miners. Pretty picture being painted here. Evolution up by 5.4%. I had a chat with David Franklin from Argonaut Securities a little bit earlier on. And you can listen to, well, he's still inclined to go with some of the bigger players in the gold space here. Deep Yellow, deep discount, down by 8%. Paladin off by 11, close to 12%. Price of uranium not doing these companies any favors. But yeah, Deep Yellow putting off a final investment decision on an African project because of the depressed price. So just run you through a bit of news. Macquarie, as I said, selling its North American and European asset management business to Nomura. There's Deep Yellow, as I mentioned. Yancoal reporting a 19% drop in thermal coal sales in the first quarter. It's blaming subdued short-term demand, also, you know, the uncertainty in regards to global growth because of Donald Trump's tariff situation. Bellevue Gold says that it anticipates a significant increase in FCF, so free cash flow, between now and the end of 2025. Bellevue was hammered last week. It's probably one of the only gold miners that is not benefiting from the current price. And Drone Shield, its highest quarterly revenue to date, $33.5 million, up 102% on the PCP. Clarity Pharmaceuticals, it has been such a wild ride for investors there. Arguably being affected by the Opthea news, but Jefferies cutting its price target on its downbeat outlook. Jefferies also says it's not optimistic about the near term for SEEK, downgrading it also with the timing of Easter and Anzac Day. Welcome to the COB. Martin Crabb from Shaw and Partners. Nice to see you.
Good to see you too, Nadine.
Okay, so this was, I thought, an interesting day. I thought we might be lower. You?
Yeah, absolutely.
Okay.
Yeah, I thought we'd be a lot lower. I thought it's not often we have a lead from Wall Street at the start of the week. We normally set the pace and go off what happened on Friday. So to have them trade Easter Monday and trade so weak, the markets were down 3% before a little bit of a late rally. And we just opened on the lows and just caught a bit all day. So what's going on, Nadine? It seems like there's asset allocation shifts going on. I think investors are moving out of the US and they're moving everywhere else, and that includes Australia. And it's clear that it's passive buying because you look at the stocks today, the big index components, BHP, CBA, CSL, all stronger in what's a weaker macro environment. So look, not a lot of volume through, probably maybe a third or maybe a half of normal volume today, so it didn't take much. But yeah, that CBA at 167 a share is defying all logic, and it just shows that people are looking for, one, Aussie stocks, let's get out of US. Secondly, things that are domestically focused. We don't want stocks that have got anything to do with global trade or tariffs. And thirdly, maybe defensive, maybe paying a dividend yield. So the banking sector really stands out. But CBA is now 12% of the ASX 100.
It's
so
crazy.
It gets 12 cents in every dollar that's being put into the country. And I think 60% of the register is retail investors. And I know from first-hand experience, they just don't sell.
No.
They're just, they're long at $20 or $30 a share. They've got a big capital gains tax bill. So even if they think the stock's expensive, they ain't going to sell it. So pure supply demand. But, it's hard to see that changing. It's hard to see the narrative for defensive Aussie domestic focused stocks that are big in the index catching more bids.
Yep, CBA up by 4.34%. And then you look to some of those traditionally defensive names like Telstra, like Coles, like Woolworths. So international money, I guess US exceptionalism, in your view, is it over?
Yeah, clearly. I think the last piece of the puzzle, or the last piece of the narrative, is CapEx, is AI and AGI CapEx. So we'll see the whites of the eyes on that in probably Microsoft's result. I think it's on the 9th of May. And they'll come out with CapEx guidance. At the moment, they're saying CapEx will grow around the same rate as revenue, so about 12% growth in CapEx. And they're probably spending, $80-90 billion or something like that. So if they blink at all on their CapEx spend, then that could be another leg down to US earnings. But just reading over the weekend, a lot of strategists are just reducing their US GDP growth. They're just saying, look, if we run the tariffs that are in at the moment, not the reciprocal ones, but 10, and then China, we're looking at getting growth down close to zero in the US this year, and probably 2 quarters of negative growth in the second half of the year, so a recession, let alone if we go back to reciprocal tariffs. So most economists are cutting their GDP numbers, and therefore earnings growth has to come down. So earnings growth is still sitting at about 11% for this year and 15 or 16 for next year. Both of those numbers look very, very vulnerable. Yet you go outside the US, Australia looks okay, right? We'll get a little bit of a knock around from global trade, but not significantly. And unlike the US, which will have inflation, the central banks everywhere else will be able to cut rates. So, our good friends at UBS are now saying four cuts this year. They've been at 2, and the market's pricing in maybe 5 cuts.
You're talking about here in Australia?
Yeah.
Yeah. It's so interesting. What happens if Trump gets his way and Powell's out? Or does Powell get strong-armed into cutting rates, even though inflation is a very real prospect in this trade environment? You
start questioning the whole infrastructure of the US system if the president can get rid of the head of the central bank. Because every other country that's happened, that's crazy. That's like Turkey, right? So you think that the US has these institutions that have been put in place to stop that sort of thing happening. So yes, he can write tweets and stuff like that, but Powell ain't going anywhere. His term's up in February next year, so it's not like he has to wait forever for the guy to go. But what it would say about the dollar, about the bond market, about the economy, about the about the president's power, all those things are a concern. So you'd see Treasuries sell off on the back of it. So even though, perversely, he might get what he wants and get a governor who cuts rates, the bond market, which is what mortgages are priced off in America, will go the other way. So he's not going to get what he wants by getting rid of Powell, that's for sure. But it's just I think the sell-off was much to do with the Philly Fed numbers that came out as the jawboning against Powell. I mean, everyone thinks it's that, but the data that's coming out is still pretty bad in the US. So I think it's nervousness around that as much as it is around Powell.
Mm-hmm. So do in US earnings, the recession is not being factored in to forward pricing in your view, but what about interest rates being priced into stocks here, interest rate cuts?
Yeah, I think they're starting to, Nadine. I think, I sent through a chart of what the futures are pricing, and now there it is. Now we're down to sort of 2.9, 2.8. By the end of this year, and holding at that level for next year. So that's 5 cuts. So hence why the bank shares are going up. Hence why real estate stocks have been well bid, utilities, telcos. So the more you look like a bond, as in your stock looks like a bond, i.e. it's got stable earnings, it's paying a high yield, i.e. it's bond-like, the better bid you are. So equity investors are moving out of growth stocks into bond-like stocks. Interestingly, the terminal rate that's priced into the cash futures is down now, 2.7, 2.8. The bond market's not rallying, so the bond market's still staying high. So we're seeing the difference between those two numbers is the term premium, and we're starting to see that go up. So it's a signal to investors, if you haven't done it already, to start thinking about locking in some higher rates, because your term deposit rates next year will be 3. We'll have a 3 in front of them. Mm-hmm. A lot of people getting 4, 4.5. And they're living off that income. That income is going to fall by a third, right? So you want to start buying 10-year government bonds, 30-year government bonds, longer dated bonds where you can get, I think 30-year bonds just under 5% in Australia. So that's effectively a risk-free rate, right? Mm-hmm. As long as you hold the bond to maturity, you'll get your money back. So that's starting to look attractive for the first time in a long time. And most investors, you just say, look, stay short duration because the RBA is on hold. But if the RBA is cutting, you want to start adding duration to the portfolio. And that means adding bond-like things to your share portfolio. So real estate, banks, these sorts of things.
Mm-hmm. Okay, so when will be the time to add growth back into portfolios, do you think?
Good question. Look, I think the narrative says you don't buy the first cut in rates, you buy the last cut in rates. You just never know when the last cut is. But I think, look, if earnings growth revisions continue to be negative, and they will be for the foreseeable future, in my view, you want to wait at least 6 months for that process to play out, because we're starting to see earnings revisions, negative earnings revisions now. We've got to get through reporting season in the US, which is happening. It's just started. Mm-hmm. We've got to get through what we call confession season in Australia, which starts with the conferences in May. Mm-hmm. So there's a couple of big Aussie equity conferences in May. You've got to get through that, and then you've got to get in towards financial year into June, July, August reporting season, and then and that's probably when you'll see earnings start to base out, because you'll probably have 3 or 4 rate cuts by then. So we're not looking at something you want to do right now. I mean, there is the buy the dip narrative, Nadine, and that's worked really, really well for like 10 years. I don't think that's going to work well now. I think we're heading for a recession. Unless things change on the political front, which they may do, we've got to start pricing a recession into stocks, and we're not there yet.
Well, that just saw my year flash in front of my eyes with that rundown. Okay, good. Now, I just would like to ask you, I mentioned deep yellow. Obviously, that's in relation to a specific idiosyncratic decision that they have made.
Yeah.
But is your faith in uranium being tested by the price?
Absolutely. I mean, Paladin today down 12%, back down to low $4. I mean, we've got a $9 something price target on the stock. And we have brought down our long-term uranium price. So we're over 100, 120. It's clear that it's very susceptible to a change in the AI/data center narrative, and there are investors questioning whether we need to build out AI and whether we need to have nuclear reactors built to fuel it, which is the narrative. So I think people have been backing off that. The issue, so we're in Paladin in our portfolios. The issue there is its market cap's getting to a point where it starts to get kicked out of the index, kicked out of the ASX 100. So there is a lot of money going out. Was there a lot of hot money in uranium? Clearly there was. Like there's hot money in gold right now, but our thesis is being tested. Do we want to sell the stock at $4? Absolutely not. We think it's worth a lot more. But the company's facing more headwinds in terms of the price dynamic and also the market sentiment at the moment. So I think you've got to look through the valley on these things. I think it's tempting to say, well, okay, it's probably got a bit more downside, I'll move out, but that's probably the wrong decision on Paladin in my view.
Yeah, interesting. And just final, sorry, I know I'm pushing the friendship here, but gold, it's just incredible to watch this, rise day after day, record after record. So the Aussie gold miners still have life in them? It
feels really frothy. I mean, look, I heard David Franklin. I really respect him. He's been around the market for a while on gold. And look, our gold team, Andrew Hines, our head of research, has been covering resources for a long time. Dorab, postmaster, our gold analyst over in WA. They're saying gold goes higher. I mean, it's difficult to see what's going to stop gold. It makes a lot of sense geopolitically right now when you've got all this uncertainty, and maybe the president sacks the head of the Federal Reserve. That's a geopolitical risk. Gold will go up in that circumstance. The gold miners, and everyone said this, have not kept pace. The gold price has massively outperformed the GDX, the gold mining index. So I still think there's value in your Evolutions and Newmonts, Northern Star, Genesis, all these guys. Ramelius is another one we like. I think the big cap miners have still got more room to move, but it feels frothy, right? With $3,500 in Aussie terms, we're over 5,000. I mean, they're big numbers. Everyone's making a lot of money, so it kind of feels frothy. But the way I look at it is I look at the weight of the stock in the portfolio. The market's come off, the gold stocks have gone up, so it does suggest that I trim the position, not sell it out, but just trim the position. And I think that's just portfolio management. So I think that's maybe you do a little bit of that, but you've got to be trading from the long side.
Such interesting times, Martin.
Absolutely.
Thank you. Really
You're
appreciate your insights as always. And you can catch up with that interview with David Franklin on the website, ausbiz.com.au. If you are listening to this in podcast form, you really should go over to the website and catch up with what you've missed today. You may have missed that the stock of the day was deep yellow. Andrew put the question to Josh Barker from RiverX and David Lane from Ord Minnett.
This has obviously meant one of their key projects is not looking like it's profitable to go ahead. So, they're not set to really go into production with their first mine until late 2026. Whereas other, the comparables, so your Boss and your Paladins, they're obviously in production now and, ramping that up in a big way. So if the price does fall further, at least these companies have made money in the last year or so. Obviously, if it continues to go higher on a longer term basis, then these companies do well, but it'll take Deep Yellow a little bit of catch up to then go and reassess.
What they've done is delayed their investment decision until the uranium price does improve up towards that $100 price range. Now, it has been below that for quite a long time. So I guess the question for Deep Yellow is, will the price get to a level where that resource becomes profitable? So I tend to agree with Josh that, I'd prefer to either be in Boss or in Paladin.
All right, let's get across some of the leaders on this market today. No big surprise to see some of these gold miners leading the pack, and this is in percentage terms. So when you look at Commonwealth Bank, they're up by 4.3%. I mean, think of the market cap. That is the influence that's having by market cap on the market overall. So really, really extraordinary to see Commonwealth Bank putting that on in a day. All right, let's look at some of the laggards. So Paladin, as we were just discussing, down close to 12%. Zipco off more than 9%. And Polynovo, again, one of those growth companies, not doing very well today at all, off by 6.7%. In the small to mid-cap area of the market, look no further than those gold miners. Again, also critical metals, of course, China restricting critical metals, including rare earths. And that has been good for some of these companies. The flip side to the story, though, is in just this sort of motley crew of names. Orthocell off by close to 11%, and American Rare Earths down by 11%. Now, overnight, so we've got a real big focus on Fed speak ahead of the blackout period before the next FOMC meeting. We are widely expecting Jerome Powell to stand his ground to keep rates on hold, but we'll see if we get any commentary around any of Trump's comments from Jefferson, from Harker tonight, see what they're thinking in terms of inflation and tariffs. We also hear from the ECB President, Christine Lagarde. And tomorrow, we get flash manufacturing PMIs. We also get quarterly reports coming from the likes of Woodside Paladin and Insignia Financial. So let's recap what happened here on market. We do have the S&P ASX 200 closing flat at 7,816. So you can see the COB Australia index did a bit better than that there. But I've got to tell you breaking news at this moment. So we're recording this at about 25 past 4 here in Sydney. Spot gold extends its gains to hit 3,500 per ounce for the very first time. So the rush to gold continues with spot gold extending its record run. And we'll see what Trump has to say if he responds to any of the big fall, particularly in the US dollar, the rise in Treasury yields as he tries to browbeat Jerome Powell into cutting rates there. All right, that's it for today, this Tuesday, the 22nd of April. If you've missed anything, you can catch up on ausbiz.com.au, and we will be live from 9:45 Wednesday morning. Hope to see you then.